introduce you to our speaker today. Maybe some of you have already met him or know him. I'm joining today from our headquarters in Switzerland, but John is our risk consultant based in Kenya. He's based in our Kenya offices. He has more than 11 years of experience in operational risk management. And before joining NetGuardians, he worked at Citibank for many years, holding several positions. So we have a lot to cover today. Without further ado, I let John continue with his presentation. Thank you very much.
Okay, hi Mina, you can hear me clearly?
Yes, we can hear you very well. Thank you.
Great, thank you. Good afternoon, good morning to our participants of today's webinar, which is basically to discuss this new area of using behavioral analytics to fight fraud. So our agenda is 4 items. We'll look at some challenges around banking fraud, look at NetGuardians' approach in this regard towards fighting fraud using behavioral analytics. We'll look at some product features and look at an example in which external fraud is being managed using behavioral analytics using our solution, and how to integrate that as part of your operational risk management. So some recent challenges, just to have a grounding, is that banking fraud is one of the areas under operational risk management, and it's an operational risk issue. According to Basel II, there are 7 types of operational risks, including internal fraud, external fraud, and so on. But today our topic will be on how to manage the first 2 under internal fraud, external fraud, using behavioral analytics. And we know basically the explanation for operational risk is where there is weakness around people, process, systems and technology, and external events. And just a quick one is that banking fraud usually refers to financial losses arising due to fraudulent transfer, either initiated internally or externally using the available customer channels. And why we see this banking fraud becoming a problem is that we now have technology, and fraudsters are also using the same technology to defraud banking institutions. There is a high level of connectivity across the world, so you can actually run these fraud rings from anywhere across the world because you now have access to the World Wide Web. Customers are now demanding, use of customer channels. They're no longer going to the bank, and this has increased touch points to the bank because you can imagine if all customers have access to the online banking channel, then the input to the bank is now increased exponentially. And we can see now that fraud is now an organized criminal activity, and it is being used as one of the ways to finance issues like terrorism, drug trafficking. It's becoming one of the best ways used by fraudsters to amass a lot of wealth. We know banks are now heavily investing in real-time services because of fintech companies pushing this agenda. However, we see one of the big issues is that banking institutions always have a tendency to catch up with risk management. So it's mostly after the fact situations where they roll out a lot of services. However, they're usually not prepared from an operational risk angle to be able to mitigate what will come through in the future. Internal fraud, as has been mentioned before, is what constitutes 70% of all fraud, of all banking fraud, being internal. So this is a big challenge. The true scale is usually unknown, and essentially because not everybody will want to share statistics on internal fraud or fraud for that matter, because it becomes an issue of reputation. Again, just to highlight this, is that we have what you call the fraud triangle on the internal fraud, where you have pressure, opportunity, and rationalization. This is mainly what contributes to fraud. Most fraudsters at point of committing fraud mainly may not have planned or may not have had the need, but sometimes due to pressure in life, you know, your colleagues are driving a good car, you also want the same. You see an opportunity where there are poor internal controls, or they don't exist at all, or management does not have oversight over that area. And then you rationalize by saying, you know, I don't even get paid enough. So that usually is what, according to Donald Cressy, the criminologist, is how to identify a pattern. So banks must implement internal controls to be able to curtail the opportunities that will exist for the fraudster. Nothing much you can do about pressure, nothing much you can do about rationalization, but where to curtail fraud is essentially at the opportunity level, where you have to ensure that your controls are, one, effective, and two, that a lot of management oversight exists over that area. So this is just setting the basis. And you can see, as I've just mentioned in the previous slide, our major causes of internal fraud are three, according to ACFE report of 2016. Lack of internal controls, 29%. 20% is people override the existing control, and this is very closely linked to lack of management review, because it's expected that if somebody is overriding any internal controls or processes for that matter, then management must come in with a big stick and ensure that this does not happen. So these two factors contribute 39%, and they are really highly linked, as well as management review as well, also highly linked to lack of internal controls, because this culture of risk and compliance and control must be led from the front, and that we're talking about management. And because we're talking about behavioral analytics, which is executed through recent technologies and on big data, it is said by the report to the nations of 2016 that proactive data monitoring was associated with 4% lower losses and fraud was detected in half the time. This essentially means that the only best way to manage fraud or fight it is to use technology, and it comes with verifiable statistics as published by ACFE as to how it actually leads to reducing instances. And the whole essence is about prevention and not detection and investigations, where now we as banks, they're supposed to be moving away from that. Just some on this area of external fraud, cybercrime as well, as you can see here, by 2021, projected to reach 6 trillion. And this is just a figure through projection. It can actually change, and we think it's going to be much higher. And external fraud, as we can see, mainly is perpetrated through channels, transactions coming in from mobile banking, internet banking. And what we see is that all aspects of external fraud have an input of insider, that means collusion with bank employees, so that they can provide either access to the bank through downloading a malware, or giving out usernames and passwords, or sending out a lot of confidential information, which these fraudsters will use as basis for launching the external fraud and defraud the bank and its customers. We have some good examples, recent ones. We talked about the SWIFT attack that has recently affected the banking system, using what they call Lazarus. This is the name behind the recent cases of high-profile cyber attacks, where they would infiltrate bank systems. And essentially, these fraudsters, as we said, interact with the insiders to understand operating procedures. And when we're talking about operating procedures, we're talking about static way of managing risk. So, for example, you'll say transactions above 10,000 should be flagged for further review. And this is the old way of control, applying controls. And when we speak to behavioral analytics, we are talking about, as we shall see in later slides, is understanding the human behavior. So there could be customers who transact, for example, above $10,000. Does that mean you'll freeze all these transactions for review? It is not. It is practically impossible. And at the end of it all, this Lazarus will just move huge amounts of money out of the institutions. The common example highlighted last year, as well as this year, was the Bangladesh heist, where they lost $81 million. We had huge credit card fraud of 300 million, ATM fraud in Japan, $18 million in just under 3 hours. We had actually gotten away with that much money. So this is something that is really existing. We can see external frauds, as much as they may not be a lot, but the impact is really painful because it comes together with reputational risk for the banking institution. On top of that, regulators will come in strong, conduct audits, and probably put in place an inspector just to ensure that this does not recur, because it's an impact to the whole financial system. We can see some of the challenges of this with old ways of managing fraud, is that they were mainly rule-based. And as I had given an example of $100,000, it's reactive, it's manual, it's not scalable, and you cannot leverage on existing data to correlate events happening across the IT layer, the transaction layer, and looking at the core banking. So it was mainly silo, meaning that there are only teams managing certain aspects. So they would not have an enterprise-wide view, which is a big weakness in managing fraud. And the solution is really what we are seeing today on behavioral analytics, global profiling, and machine learning, but mainly down to, first of all, what is the behavior of this human person? What is the behavior of customers? What's the behavior of the staff? So it is very individualized, and you're not put together in one basket. And why are we talking about behavior? Because in terms of managing this operational risk area, the big focus should be on prevention and not detection. Here we see before the traditional approach, as we've just mentioned, with the manual processes, rule-based, banks are mainly down to acting as a victim, where their work was mainly to do investigation after frauds have happened. Maybe customers have complained, and then they kick in the investigation processes. So they would have large teams of security investigation. Their work was mainly to investigate. That was the traditional approach. However, with Basel II and regulators coming in very strongly, this is no longer an acceptable approach. And banks have through fintech companies like NetGuardians, where we propose some very radical ways of this. And now the whole idea is no longer to act victim, but to catch the fraudster even before they commit this crime through what you call behavioral analytics. The result is proactive fraud detection. And from ACFE statistics we saw before, there is reduction in half the time in terms of catching this, and there's huge improvements in risk write-offs going to the regulator, and this is directly linked to the capital requirements by banks under the operational risk framework, because the lesser fraud losses you have, the lesser you have to allocate capital in that aspect. As you can see on the right of this screen, the top one is a rule-based approach. The bottom one is the behavioral analytics. Basically, customers are not the same. Behavior of staff members are not the same. And that actually, the bottom picture on your right represents that it is not the same. So you cannot actually put everybody in the same basket and rate them in the same typical behavior. So the whole essence of behavioral analytics is that you establish a baseline for each and every individual. And then from that baseline, you can now be able to detect and say, does the kind of activity this person is doing now, does that reflect who they are? And the answer is either yes or no. And based on that, you then take corrective actions. Now, in terms of modeling, for example, this is just an example on e-banking fraud. When you talk about baseline, you're talking about some characteristics of a transaction, or what you call the variables. You're looking at counterparties. You're looking, for example, at the language. You're looking at the location. You're looking at the currency, amount, device being used, transaction types, IP addresses. These variables have no end in real terms. So you can actually have as many variables as possible. Actually, that makes your model even better, because now you're able to correlate all these events together and make a determination. And it's always very close to the normal. We know this is a science. Sometimes with science, you'll have plus or minus situations, and that's really acceptable. The whole idea is to reduce that plus or minus to a very, very minimal point in such a way that it does not in any way greatly affect the outcome of your results. And what we're talking about here is a risk score, and that is what is relating to the modeling, whereby you put all these variables together and come up with a risk score of when you combine all this and correlate all these variables for that specific customer or internal staff. And the result is simple. Once you calculate your risk score for that particular transaction, is it greater than the trigger value? The trigger value is calculated internally by the system as part of its learning capabilities. And the whole idea is that once the risk score is greater than the trigger value, then generate an alert. Could be stop the transaction, it could be call back the customer, it could be request for additional authentication questions, maiden name. We know banks are now asking for additional information, and this information is private to the customer. So if the fraud ring is able to, for example, conduct man-in-the-middle attacks and hijack a session, they might not be in a position to know some of this private identifiable information belonging to the customer, and that's the point at which then the fraudster will not be able to complete the transaction. But however, that can only come through understanding the behavior of that particular customer, because once the session is hijacked, the credentials will look okay to the bank. The username and the password is okay, the transactions are fine. But if you actually analyze the behavior of that customer, you probably understand from the characteristics you are seeing on this spider web that the amount is high, the language could be different, the IP connection could be from a different country, this is probably a new counterparty, destination country is high-risk country, and therefore freeze that transaction as much as the username and password look fine. In terms of e-banking fraud, and we'll look at an example here, the general operation is that the customers connect to the core banking where the transactions are happening through the channels. On the left, you'll see three modes. You'll have an infected customer computer, you'll have a genuine customer, and you'll have social engineering. So these are actually valid ways in which people will connect, and they are accurate because the username and password or authentication mechanism is on point. Once the information is received at the core banking layer, this is passed on to the NetGuardians analytics behavioral solution in real time. And near real time means it is something in terms of milliseconds, because this prevention, when we talk about prevention, we have to talk about the fact that it is very close to the real. Where we do the scoring that we have looked at in the previous slide, that is a risk score. So we score that particular transaction against the existing customer profile. If trigger is high, if the score is higher than the trigger, then we will either alert the security team, the risk compliance, that there's a probable hit. You can also alert the front office. This is a customer service who are in direct contact with the customer. And the back office can actually either freeze that transaction or just spend it, awaiting further verification. And then just to dive deeper into the NetGuardians action, once we do the scoring of that transaction, suppose there's a suspicious transaction that has been detected. The transaction is blocked, and as we saw, a message is sent to the client's manager so that they can take action. It could be customer service, but somebody within the institution will be notified. And this notification process is purely dynamic, so you can set as many notifiers within the system as possible at the first line or the second line defense. So this is an example of a hit. As you can see here, there's a transaction of $5,000. The counterparty is the Bank of Gambia, and this money is moving to Costa Rica through the SEPA method of payment, usually used around the European Union. But that's just some of the attributes of this transaction. On the second box, you can see that the risk level for this transaction is high, and the reason is that the score here is 20.09. You can see on the bar that you're moving towards the red zone, meaning this transaction is of high risk in comparison to the expected behavior of this customer. And we can see here from the attributes on the left and what you call the partial scores or the weighting of the score on the right, that you have days of the week, part of the day of different color. You can see that there are some risk scores in red, meaning that in terms of country of connection, this is high risk, city of connection is high risk, the counterparty is high, the counterparty bank is high, and the payment type is also very high, probably hitting 100. So from this, you can actually tell that this transaction, the biggest issue of this transaction is that this is not a common connection. It is maybe a first time that the customer is connecting from. And it could be actually an issue of session hijacking. It could be an issue of social engineering. It could be an issue of hacking of the customer credentials. And therefore, that actually contributes in a large way to this customer risk score of this particular transaction being high. And here you can see from the case management system, this is where, as we say, the notifications will be sent out on email. However, a copy of that notification is stored within our workflow system, where somebody can go in, look at the issues that are popping out, determine whether the situation is of importance, whether you need to call back the customer, whether you need to completely block the transaction. And this is the workflow system. So from the previous example, the one we just looked at, this is the second item on this workflow system, what you call the case manager, and you can see the country of connection here is Costa Rica, the city of connection is San Jose, the score is 20.09, what we saw previously, and we have much more customer details, including the currency, the amount, the account number affected, and so on. And if you just deep dive further by clicking on the previous, if you click on any of this link, it will actually take you to the forensic view. This is where now you can, as a, for example, your customer service manager or you're the relationship manager, you can quickly see on the left the countries this customer is used to connecting from. On the right, you can see the kind of menus, the kind of transactions that they processing. And this is not only, this view is not static. As a customer, you have capability to tweak this view to seeing what variables you want to see. Now, but this is essentially, as we said, as you saw from the risk score previously, that the connecting country is of high suspicion. And as you can see, there's a Costa Rica country on the bottom of this country. Switzerland carries a high number of connections. So it's an expected event. Costa Rica on the bottom of this, on that connection, shows that this is not an usual expected connection. And you can actually dive deeper by clicking on Costa Rica, and the filter is added. And now you can see that there's only one sort of connection, the SEPA payment. Below there, you can see the value of the transaction, the date. And this actually, now if you click, for example, on another country like Albania, you can see that the customer is doing many more activities on the system. And as you know, fraudsters just are no longer interested in playing around with the system. Their goal is to go in, quickly do what they need to do, and quickly exit the situation. So if you can see at Albania, the customer is probably doing many other activities. It's expected that once they log in, they'll do one or two things, make payments for tax, for insurance, pay a telecommunication company. But however, for the case of Costa Rica, their goal was one thing: log in, move money, log out, they're done. So this is what now is causing a lot of concern to the bank or to this particular transaction. So as you can see there, the key takeaway, as we are seeing with behavioral analytics, the whole essence is to prevent fraud. No longer happy with detection and having a large team, happy to have investigated and found out that money was lost. That is not the essence. And we know that money lost is rarely recovered. There is no chance of recovery. We should make use of existing technology, for example, big data technology, machine learning, which is not only being used in risk management, it's being used in many aspects of this world. to be able to make better decisions, real-time decisions, and it is vital that we use this analytics to detect, as I said, we have to detect these unusual activities. Machine learning is also an aspect of this behavioral analytics, and the whole goal of machine learning is to continuously improve the model as you continuously learn the behavior of this customer. It may change. The customer behavior may change. They might start doing large transactions. They might have moved their locations where they're doing a lot of transactions from. So the machine learning comes in to really reduce false positives, because banks are no longer interested in hiring staff for the sake of hiring. This staff must come in and add value, and that value has to have an underpinning technology behind it. So the lesser in terms of false positives and negatives you have, the better your model. And as we said, the essence is not to no longer to take advantage of manual intervention. That is now past things of the past. Now we are moving towards simplification using all these models. Automation being one of the key takeaways. So at this point, because I was just supposed to take 30 minutes, so I'm right on point. Mine, I could open the floor for some questions that our participants could have thrown at us.
Thank you very much, John. So today, of course, we could look at one specific use case. We could understand how we can use behavioral analytics and profiling, for example, looking at suspicious e-banking transactions. And we have actually one question, because in the beginning we have also talked about internal fraud. And we have mentioned that actually 70% of all banking fraud is internal. This is really huge, and this is a big problem. And what about internal frauds? Like, how can we use actually behavioral analytics and profiling to fight internal fraud? Can you give us some examples and how we can actually implement the solution there?
Yes, correct, Mine. I think internal fraud being a big concern for banking institutions, and the focus here will be on employees, their typical behavior. So you're looking at what time they log into the system, what time they access the bank, and you can actually look at, for example, their spike in their behavior. So if somebody is, for example, sending large data sets through email, or it could even be through social media, and they're using the bank network, those spikes in behavior of, for example, sending large data sets within a period of time, it could be, for example, during end of day or outside business hours. I mean, those kind of behaviors can actually be analyzed. So, for example, if you see typical behavior of an employee just sending emails to customers, but now they're sending in large data sets, then that will cause for further investigation, because that's not typical human behavior. We know banks, for example, set maximum, setting of huge files, maybe to 20, 30 MB. So if that is not surpassed, no one will raise a query, and that's the traditional approach. But now the whole idea is to say, what's the behavior of this customer? They typically send large sets of data? No. Then highlight that. Another good example would be, for example, highlighting another high-risk behavior around, affecting sensitive accounts. It could be internal accounts. It could be PEP or publicly exposed individual accounts. So when you start seeing movements of money, let's say this person works with funds transfer, their typical day would be debiting the customer account and maybe crediting the nostro or the clearing account, and so on and so forth. So when you start seeing money moving in between the customer account and some specific sundry accounts or other high-risk type of accounts, then that can actually be one way of saying that this is not typical funds transfer staff behavior. You could also look at teller accounts. When you see tellers specifically will view an account and then process the transaction where the customer has come before by debiting the customer and crediting the till account. But now you can see they just looking and viewing and browsing through customer signatures or modules around critical customer data like addresses, and with no follow-up actions on in terms of processing. So that again could also highlight a change in behavior. because you can see the staff member reviewing all these typical activities, and it's a spike, for example. And usually this would be done during low movements when there are not many customers to serve. So this could just be examples. And as we said, a behavior is understanding the typical characteristics of that person. It could be the customer, it could be the staff member. And from those characteristics, you can actually build a behavior model and see whether at some point in time, this model changes. And once that changes, then it is subject for further review. Thank you.
Thank you, John. And we have one more good question. So how can we then manage the migration from the old way of managing fraud? We said it's based on rules, it's manual. And how can we manage this migration from the old way to this new way, which is more automated? And what are the requirements? So how can we actually implement the solution and move efficiently from old way to the new innovative way?
Okay, thank you, Mine. I think one of those things, and you're looking at a very good operational risk management model within a bank. One of those things that has to coexist is having a culture of controls compliance, and that everybody has to be aware what's their role in fighting fraud. Is my role just processing transactions and bypassing those controls? No. So at the three lines defense, everybody needs to know what their role is. And that is essentially building that culture of compliance. There has to be continuous training of staff members, of new processes or existing processes, and ensuring that, for example, during execution of their risk self-control self-assessment, that they actually understand their processes and they know what controls are critical in ensuring those processes are up to scratch. And then finally, you have to carry out your fraud risk assessments on a very frequent basis. You can use legacy data, for example, loss data, internal or external loss data, to come up with lessons learned and what corrective actions you need to put in place. Or you can use forward-looking models like a scenario analysis. We can see there's ransomware now across the world affecting many institutions. It may not have affected you as a bank, but for example, when you replay that scenario within your institution, what kind of controls do you need to put in place? And you'll be able to understand that some of these things cannot be manually achieved, that they have to be achieved using an automation model. And that is where now, for example, with NetGuardians solution, you can actually look at such automation models and understand what's happening. And finally, industry leaders or research companies like Forrester, like Gartner, like McKinsey, and so on, actually saying that this is the new frontier. So as an institution with continuous training, awareness on the existing, whatever is happening in the market and keeping in touch, assisted by internal control effectiveness with very good oversight from management, existence of internal controls, having a very good culture, a lot of communication and awareness, then that forms a very good basis for you to launch a proper fraud prevention model within your institution. Thank you.
Thank you, John. And what about the implementation time? So there's a question, so how long would it take to implement a solution? So we also connect to the existing core banking platforms. Could you also give us some information about the implementation process?
Yeah, the implementation process initially will probably take anything up to 8 weeks. And it is important that there are two aspects. One, you have to have sufficient data about the customer. So you have to collect a lot of information to be able to build a very good understanding of that customer behavior. So if you, for example, use 3 months data, your model may not be very accurate. If you use 6 months data, you'll probably have a very good, accurate model about this customer behavior, meaning that there's less and less of false positives or false negatives. And then the other thing is, this model that we use is continuously learning. However, and as I've mentioned, with forward-looking models, meaning that you're no longer looking at loss data that has existed before, so you're trying to learn previous fraud methods, you're now looking at the future. So if you're looking at the future, you can, and from the attributes that we saw, you can actually, as a customer, decide to weigh some of those attributes higher than others. So as much as the system is internally calculating for you the trigger values and what should constitute a high risk or a low risk score, you as a customer must continuously ensure that you look at the attributes and weigh them appropriately. So sometimes you might find that connection of countries is now a big issue. For example, where all this ransomware and cybercrime activity is coming from. It's coming from certain high-risk jurisdictions. So therefore, as a model, you have to, as a customer, go in and pick that and increase in terms of the input in the risk score. So you weigh it higher. And probably you will lower the currency because maybe all these transactions are going out through USD. So just to summarize, the 8 weeks is sufficient to just build a basic minimum model. However, a lot of tweaking, a lot of fine-tuning can even take up to 2 months because there's a lot of learning that has to go in before we say this is a good model. So projects can even go up to 6 months, but minimum, we see anything 2 to 3 months, you already have a good picture of what's happening within your customers and your employees. Thank you.
Thank you, John. And today we talked a lot about, we gave some examples regarding e-banking, doing transactions over e-banking, but there are certain banks that although they have e-banking, maybe they are used just for consulting the accounts and they are not really using e-banking platform for transactions. The clients are not using for transactions. But we can imagine that, for example, the customer is calling the bank. It can be through a fax or a call, and then asking the banker to make the transfers and the payments for him. So in this case, how can we use actually behavioral analytics? Because it's not really on the e-banking platform, but then the payment, the transaction is still there. So could you explain a bit, in this case, how we could still use behavioral analytics?
Okay, so I'll just go to a slide that gives us a good representation of what you're speaking to. It was this slide where on the left, there could be many ways in which transactions are coming through to the core banking. So as you rightly point out, for this private banking, somebody will call in or send a fax and say, please process for me the following transaction and move money around, okay? Then I will go to this other slide. Now this slide is where you are now going to calculate your risk model. And as we say, your risk model is made out of quite a number of attributes, transaction attributes. So it could be the counterparty, it could be the location, it could be the transaction type. Was it through a fax? Was it through a phone call? Does the customer typically send a fax or through email instructions? What kind of amounts are they processing? What kind of currency are they using? So in this example, for example, you will see we no longer need the e-banking language as an attribute. We no longer need the location as an attribute. However, part of the transaction attribute, there are many more factors that you can pick in that can help you calculate your risk score. So once you calculate your risk score, you'll have something like this. So if you look at this, this is just the e-banking, but assume this is transaction coming through the core banking. All this will be attributes. What is the amount? What is the counterparty? And then at the bottom screen, you can see that you're calculating your risk score based on those attributes. So it doesn't matter really how transactions come to the bank. The basis of behavioral analytics is saying, what is the expected behavior of this customer? And based on the transaction that we are receiving now, it doesn't matter how it came. Does this conform to the normal behavior of the customer? That is a question that we are trying to answer using this risk model. And therefore, the system will tell you that this is either a high-risk suspicious transaction or this is, falls in the normal curve of this customer behavior. Thank you.
Thank you, John. And we have a question regarding human resources. How can we dimension human resources? Again, it goes back to the question of internal fraud. How can we fight internal fraud? And we can use the data also from human resources. For example, in the past, we made projects in implementing actually using the badges or identifying, for example, if the employees or if an employee is on leave or on vacation. Could you explain how we can dimension these kind of data sources like badges and on leave to really dimension also this human resources side?
Okay, thanks, Mine. Essentially, so the new attributes, for example, what's the employee behavior? And as we said before, from the HR perspective, it could be leave records. It could be, for example, you see a staff member never going on leave. That is a high-risk behavior. And then, typically, and as we say, part of culture is to ensure that employees go on leave. And the whole idea is that somebody else will be able to take over what they're doing. And these are usually times when frauds will be discovered. If somebody has been hiding a transaction or, avoiding a reconciliation, because which may uncover their, fraudulent activities, that is the time. So if you look at, for example, the behavior of staff, and you see that this person never completes their leave. So if they're gone for 2 weeks, they'll be back 1 week earlier, then that's a very good, indicator of why is it that it's so important that this staff has to be present in the bank for business to continue. Or as you rightly pointed out, you can look at access records and say that what's the behavior of this customer? Which kind of departments do they like to go around? If you're a teller and you're busy serving customers, why would you be found walking around, for example, in other departments, treasury, HR, and so on? It can actually point out to a behavior. Maybe you're fishing for information, or you've gone to the clearing departments where physical checks are kept. What's the need of you going to those particular departments? So these are just attributes of employee behavior. And from those attributes, you can see what's happening. If you see an employee logging in and they never log out of the building, but you can see them logging out in another section of the building, it could be a situation where they're trying to hide their movements by ensuring that this is not logged in the access control system. So once you pick out such anomalies, it becomes a point of interest for HR to say, okay, why is this behavior, why is this staff member behaving suspiciously? Thank you.
Okay, we have lots of interesting questions. Thanks a lot. So we are unfortunately running out of time. We can maybe just quickly take one last question. Sure. What is then the best department direction that would own this project? So of course, every bank is different, the structures are different, the needs are different. That's a big question, but could you just give us a short, what would be your quickest answer? What would be the best department that would own the project, John?
Yeah, fraud management is essentially sitting with the second line defense. So depending on how the bank is structured, this should sit either within the fraud department or the risk department, which also manages fraud risk, because fraud is just one of the aspects of operational risk. So we're talking about the second line defense. That is operational risk, either fraud risk or the wider CRO team, in a nutshell.
Thank you, John. And yeah, we talked today 3 lines of defense. So the advantage is that we can actually use this kind of solution to have a coordinated 3 lines defense approach. So while the first line of defense employees can use the solution, and then after the second line as well, and the third line audit as well. So that's really the advantage also to really have a coordinated 3 lines of defense approach that would also be implemented. So thanks a lot. We are at the end of our time today, so we could cover